Hi, this is Zach Smith, your friendly mortgage broker, here to talk to you about our reverse mortgage program. I'm the owner of Chariot Financial, and thank you so much for joining us today. Well, I'm going to get right into it here and share my screen here. Let's see if we can share my screen. Okie dokie. So you should be seeing my screen here. Thanks once again, for joining us here for our quick webinar that we're doing on the reverse mortgage program. This has been such an incredible program for so many of my clients, and really, I'm kind of on a mission to really just help people understand this program, because it really is a good option for a lot of older adults right now that are looking for a way to increase their cash flow, or for folks who are looking to create kind of a financial safety net for their finances. So this is me. My name is Zach Smith, and I own Chariot Financial. Let's see if we can move the thing here. I've been here. I've owned Chariot Financial since 2019. I've been in the industry for 20 years, and this is by far the best program that I've ever originated. And it's something that is getting a lot of traction right now because of some of the benefits. And, quite frankly, one of the issues with this program is that there's just been a lot of information that just isn't true in regards to how the program is structured. And really, it's kind of a different way of thinking as well, especially when you start getting into the financial planning aspect of this program. So what are we going to go over in this presentation? We're going to go over who are typical clients that we see with the reverse mortgage, what a reverse mortgage is, what a reverse mortgage is not, why people are choosing the reverse mortgage program. I mean, why do they exist, and why are so many people choosing this option? And also, how do they work in simple terms? So who are typical clients that we see with the reverse mortgage? And this is, we see all walks of life, all types of clients for the reverse mortgage, but over the years, these are the typical clients that we see, mainly older adults that are looking to increase their cash flow. That's one of the big reasons people choose this program, because it is such a great way to increase cash flow, especially if you're living on a fixed income like Social Security. And, let's face it, a lot of people aren't wanting to work into their 60s, into their 70s. You've earned the right to take some time off and to retire with grace. So older adults some folks are in a situation that they can't retire because they got a big mortgage payment, or they got a car payment, or they have credit card debt. Those type of things can be basically rolled into a reverse mortgage, which the payment is optional for that. So for instance, if you're paying a $1,000 mortgage payment and you decide, you know what, I just want to roll this in to the mortgage and make it payment optional, you can do that with the reverse mortgage. And I want to stress that there's still a monthly payment with the reverse mortgage. It's just optional. And we'll go into more detail as the webinar goes on. Also, retirees that are looking to establish a safety net for unforeseen costs. If the market is doing really well, you should leave your money in the market. Of course, if it's doing bad, you shouldn't be taking money out, because then it's a double whammy. Wade Pfau is a prolific writer about retirement funds as it pertains to older adults, and he mentions the analogy of like climbing a mountain. You climb the mountain, you reach the top, you're retired. Oh, that's great. Well, on the way down, every mountain climber knows that on the way down is the most dangerous time, because if you make a wrong step, you can fall much faster. Even the most experienced climbers can fall into that situation where they make a wrong step and they fall much faster. Well, retirement is the same thing. You have to make very careful decisions about your income and about your finances at that time, because if you do make a wrong step, you don't have as much time to recover as you did while you were younger. So to create a financial safety net that will help protect your assets is something that a lot of seniors look at when they are trying to evaluate this program to see if it's right for them or not. So what a reverse mortgage is. So a reverse mortgage is a mortgage loan, just like any loan. It's with monthly payments. The payments are optional. Generally, and that's one thing that a lot of people don't talk about with the reverse mortgage, and that's just the fact that if you want to make a mortgage payment on a reverse mortgage, you can. A lot of people talk about the property or the loan balance increasing on a reverse mortgage. That's really a choice. If you want to make a mortgage payment, you can, and your balance would never go up. You can pay the house off. You can do whatever you'd like. You're just given that choice. If you want to make the payment, great. If not, you don't need to. Generally, generally the reverse mortgages will come with a line of credit that you can access that will also grow over time. Cash payouts. So you basically will get cash at closing. We show up with a big suitcase full of cash, unmarked bills, with a guy in a black suit handcuffed to his handcuffed to his wrist. Just kidding. No, they don't do any of that, but you can get a cash payout. Basically, they just wire funds right into your bank account. And some folks will choose to pick what's called a tenured option, which is essentially turning your home into like an annuity. It's not turning your home into an annuity, but it's like turning it into an annuity in the sense that you're getting paid each month you live in the home. So you need cash for extra expenses or things like that, and you want to receive cash back from the reverse mortgage. That is something that an option that you can choose. And when we do our assessments with our clients, we'll go over each option. And it's really important to me that you understand everything about the program, because quite frankly, I think you can make an educated decision once you understand the program in its entirety. So what a reverse mortgage is not. So a reverse mortgage is not a government takeover of your home. They don't want your home. It's like in 2008 when there was a huge banking crisis and really a mortgage crisis. There was a lot of foreclosures back then, and there was a sentiment among most people that the bank wanted your house. They wanted to take your house. Believe me, the bank did not want your house back then. They don't make money off of real estate. They make money off of charging us interest. And they've become quite well at it, if you want my honest opinion. But it's not a government takeover to take your home. It's not a way to make you upside down on your home as well. Now, can you go upside down on your home? Yes, you can with a reverse mortgage. It is possible, especially if we have like a 2008 event, like I mentioned previously, where property values plummet. But I'll tell you what, if we do get into another 2008 event, the reverse mortgage is a program you want to be in because it has a non-recourse feature. Some of the folks who short sold their home back in 2008, guess what they got from the IRS, from their lender, after your house is worth 200 and you sold it for you owe 250 on it. They got a nice little 1099 from the bank saying, hey, you just short sold your house. You got to pay us 50 grand in interest because we did that. Now, non-recourse on a reverse mortgage doesn't have that feature. Most forward mortgages, are they likely to do that? Probably not. But did it happen? Yes. Some people got a little 1099 saying, hey, you short sold your home. We want that. You're going to get charged for that interest. We're going to charge you for that. So you can go upside down. I mean, especially, for someone like me, the second I turn 55, I'm running down to the bank to get a reverse mortgage. And guess what? I'm planning on going upside down on my house. Well, that's just my personal financial plan. But that's the thing that some people will, it's much of the philosophy in regards to, do I want to pass on a higher net worth or do I want to pass on more equity? This is really the question that most folks need to ask. And then also, it's not a payment-free mortgage. AAG got in trouble. AAG is the company, big company that does reverse mortgages. They're not like a small boutique shop like we are, but they're a big company that does reverse mortgages. And basically, they got in trouble for saying, hey, we can eliminate your mortgage payment. No, they're not eliminating your mortgage payment. They're just turning it into an optional payment. So that's something to keep in mind. So why are people choosing this option? Why are people out there doing reverse mortgages? Well, it's really simple. There's two big issues that come along with the reverse mortgage loan, or that come along with retirement, and that people are looking to establish when they do a reverse mortgage loan. One is the liquidity issue. folks that are in retirement often have a lot of equity and low cash flow. Secondly, a lot of folks are looking at a long-term financial planning tool to use the reverse mortgage. So let's talk a little bit about home equity and liquidity. So equity is great to have, but it's not liquid. So it's a lot like having a glass coffee table right there in the middle of your living room full of cash that you can't get to. In other words, you can't take a picture of your house and go to the grocery store and hand over the picture to the cashier and try to pay your groceries with it. So equity is great to have. The good thing is most seniors do have equity, but the problem is it's not liquid. You can't eat your equity. So why does this matter in retirement? Why does the fact that you're not able to tap into this equity matter? Well, most retirees are on fixed incomes and have limited cash flow. And most of my clients, they don't want to work into their 60s, work into their 70s. They want to do things that they're passionate about, work on their art, write more, volunteer, things of that nature. They don't want to be forced to go into work. I was working with a lovely lady just a couple of years ago in the dark days of the pandemic when, she was a florist in one of the grocery stores here. And I asked her, I said, "Oh, you must really enjoy your job." And she looked at me straight in the eye and said, "I hate it." And I was kind of taken aback because, I thought, "Oh, you're a florist, you must really like it." But during those days of the pandemic, she was considered an essential employee. So she was terrified to go to work. You had this crazy virus going around. Everybody thought we were in a movie. Nobody knew, is this real? Is this really happening? So she was forced to go into work. And she had to work because she didn't have enough money to retire because she had a big mortgage payment. So we basically went in, converted her existing loan into a payment optional program. Now she doesn't have to make that mortgage payment if she doesn't need to. And guess what? She's retired now very happily. So also unforeseen medical expenses can liquidate retirement assets prematurely. So that's something that most people are trying to plan for. So instead of, basically just creating that line of credit, opening up that line of credit on the home so that, if you need it, you can get to it. But if you don't need those funds, then just let them sit there. It actually will grow over time on the amount that you don't take out. So that's something to be aware of as well. Let's see here. So the reverse mortgage solves the problem of liquidity. So basically, the reverse mortgage is designed to help older adults access that equity when you need it. So essentially what it does is that glass coffee table sitting in the middle of your living room full of cash just gives you a little drawer. So you can pull it out, take the cash out when you need it, put it back. And again, with the reverse mortgage, you can pay off the reverse mortgage. You can pay it down. You can do whatever you'd like with it. But you do have the ability to take cash out if there's enough room in your equity to do that. And we'll go into more detail about that. So it basically solves the problem of liquidity by either establishing a line of credit, a cash payout, or converting the existing mortgage payment into an optional reverse payment or to a payment optional reverse loan. The reverse mortgage as a financial planning tool. This is by far the most not talked about thing about this program is how people are using it to have victory with their retirement accounts. I mentioned earlier that my financial plan was to get a reverse mortgage as soon as I could. Well, my plan is also to pass on a higher net worth to my heirs. It's not necessarily more equity that I want to pass on. It's a higher net worth. And a lot of folks need to, in my opinion, it's the whole adage of cost versus value. For instance, folks, traditionally, I want to get a 30-year note, or I want to get a 15-year note. 15 years, that's going to be good because why? Because you pay less interest. Folks who got these 3% and 4% interest rates here in the past, on a 30-year fixed loan, you're still paying 50% of the entire interest in the first 10 years of that note. So if you refinance every 5 years, guess how much your principal is going down? Not very much, not very much. But, that's just what we've been told. And that's just what we do. You know, you need to buy a house. Okay, go out and get a 30-year mortgage. You know, is there really much out there else that they're offering? There are some simple interest programs that you can pay your house off in 6-7 years in some cases. So it's just one of those things where we don't know what we don't know. And, you know, I love the quote from Benjamin Franklin, you know, investment in knowledge pays the best interest. So some Americans are living longer, which creates concern about running out of retirement assets or the amounts they're going to leave to their heirs. So the longer we live, of course, the more money we're going to be spending, and especially if we have to go into assisted living facility. I know in some places, you know, if you go into assisted living, I mean, it's $9,000-$10,000 a month. So the research of Harold Evensky, Sean Pfeiffer, and John Salter of Texas Tech University, they actually published an article a few years back of the acceptance of the reverse mortgage product as it pertains to survivability rates of one assets when using home equity in their retirement plan. And, you know, this is the thing, you know, a lot of financial planners are calling themselves fiduciaries, which is fantastic. And what does that mean? That means that all of your decisions as a financial planner, and I am not a financial planner, I'm not trying to give you financial advice. I don't play one on TV. This is just, I'm just giving my opinion. A fiduciary is someone who is out for your best interest. They are by law, they have to make decisions that are in your best interest. So one of the things that they're looking at right now is that, well, you know, one of people's biggest assets in retirement generally is their home. There's trillions of dollars of equity in people's homes right now. So to ignore that in your entire financial plan is somewhat of a derelict of duty in regards to if you are a fiduciary giving financial advice. You can't ignore someone's largest asset and begin to tell them that you're giving them the whole picture, that you're looking at everything. And this next slide basically shows that. So incorporating home equity into a retirement income strategy has been found by Sachs University, Texas Tech, and several other organizations to show that if you incorporate your home equity into a retirement plan, your survivability rate of those assets goes up tremendously. So that's something to also keep in mind about this program, is it's not just a program to increase your cash flow, it's a program to help you pass on a higher net worth. So there's different types of reverse mortgage loans. The main loans that are offered in Texas are what's called a HECM loan. Now, what the heck is the HECM? So the term HECM is an acronym for Home Equity Conversion Mortgage. It is FHA's version of the reverse mortgage program and the most common. HECM loans are administered by HUD and comes with certain protections for the homeowner. These include a non-recourse feature. Now, what does that mean? Non-recourse means that if your house is upside down, or we got another 2008 event and everybody's house is upside down, well, at that point, they can't come after you for the deficiency. They're going to take that, they're going to basically incorporate that into their losses. And you do pay an upfront mortgage insurance premium with FHA loans. So that's not just the reverse mortgage, that's any FHA loans. You know, you got somebody who's a first-time home buyer, or somebody with a low credit score, or somebody who is a couple of years out of a bankruptcy, wants to get a loan. A lot of times they're going to be looking at FHA programs, and all FHA programs come with an upfront mortgage insurance premium, not just the reverse mortgage loans. Also, bank failure security. So they have security features in the note that say, hey, if this bank fails, the government will take over the servicing for that note. And then also the line of credit is an incredible tool because you get access to more cash on the amount that you don't borrow against over time. So it's something that's very advantageous for several of my clients. Well, we know who this guy is, or most of us do. You know, he was quoted as saying, you know, the reverse mortgage loan is just like any other loan. The only difference is how you pay it back. And I got to hand it to Tom Selleck and his legendary mustache. He hit the nail right on the head. So what is or why is it called a reverse mortgage? The reverse mortgage, it's still a mortgage. There's still a lien on the property. You still own the property, but there is a lien on the property. The bank's not just going to give you cash for free. I mean, they're getting something out of it. So the reverse mortgage is still a mortgage. It has a monthly payment. This payment is optional, though. If you want to make a monthly payment, you can. Most of my clients, I would say 95% that choose the reverse mortgage, choose not to make that payment. Why? Because it kind of goes against the whole philosophy. Let's say you just did a 30-year refinance and you have a loan for $250,000 and your monthly payment is $2,000. Well, guess what? You make a monthly payment for $2,000 that first month, about probably $200 of that is going to paying off your loan. The other $1,800 is going right to the bank. That's how amortization schedules work. So most people, they're fighting to pay off their loans aggressively and all that. Well, in a 30-year note, I mean, most of your hard-earned cash is going right to the bank, right, in the first 10 years of it. So that's just something to keep in mind. But so my clients, many of my clients have said, well, heck, instead of paying this $2,000 mortgage payment, why don't I just take that and put it into a payment, optional payment, not make the payment, let it go on top of the loan, and then take that $2,000 that you were going to make that payment with and put it in your pocket. So, that way you can direct it. You have control over that. It's kind of like folks who want to buy a house cash. In my opinion, I don't think it's a great idea to buy a house cash. And this is why. Because if you put, let's say you want to buy a $200,000 home and you got $200,000 in the bank, you say, I'm going to put $200,000 into this transaction. Well, once you put that $200,000 and buy that home cash, you lose all control over it. And what do I mean by that? Well, if you want to get that $200,000 back out, what do you got to do? You either got to sell the property to cash out. Well, then begs the question, where do I go? And then secondly, if you want, you have to call a bank. You have to call Chariot Financial and get a loan to pull it out. Either way, you're putting yourself in a position where you put that $200,000 in the hands of either a buyer or a bank. Now, people often will purchase homes with a reverse mortgage. It's a great purchase program. So depending on your age, let's say we're able to bring $80,000 cash to that $200,000 purchase. Well, what that means is that we'll come to the table with $80,000. You would come to the table with $120,000. Now you get to keep that $80,000. You get to keep that in the bank. So you can direct it, you can, reinvest it, you can keep it there for a rainy day, you can do whatever you want with it, but you still get to move into this house and never make a mortgage payment as long as you live there as your primary residence. So that's one thing to keep in mind with the reverse mortgages. It does have to be your primary residence. So that's somewhat the philosophy of the reverse mortgage, is utilizing these payments so that you become more liquid, you can direct your cash, and ultimately have more control over your finances. So taxes and insurance generally will be paid separately with the reverse mortgage. In some cases, they do require that we pay your taxes and insurance for you. That's on a case-by-case basis. So the two biggest myths that I see in my line of work about the reverse mortgage is, number one, that you're going to be upside down in your house in the next few years. This is a slow process to go upside down. Now, is it possible for you to go upside down? Yes, it is. It is possible. But it's also possible for you to be in a situation where you're not able to make your mortgage payments in regards to having a fixed income or things of that nature. But it is possible to go upside down, but generally in a healthy market, if we're appreciating at least 4% a year on real estate, which is the 30-year national average, you're generally going to have to get, depending on your age, maybe 100, 150 is when you actually have to have the note due. So if you live to 150, you got to pay the note off, just so you know, or move or do whatever. Or you'd have to be over 100 for this to go upside down. Again, that's in a healthy market. If you have another 2008, all bets are off in regards to that. But again, I would much rather be in a reverse mortgage if we have a 2008 event, because it's just a safer program. And then the second thing that I hear, which is the silliest thing, is that you no longer have title to the home, that the bank owns the house. That's just couldn't be further from the truth. So that's something that is part of this as well. That I just hear, and I'm just, where did you guys hear this stuff? Oh, well, I was listening to this guy on the radio, or this guy, or, my uncle says this. If you really want to know how these programs work and you really want to know about it, talk to someone who's gotten one in the last 3 or 4 years. Talk to someone who just got one and see how it's working out for them. So there's 3 ways to structure a reverse mortgage loan. Number 1, you have a line of credit. That's most popular option. This establishes a line of credit that you can access as you see fit. The amount that you don't borrow against actually will grow year over year. So let's say you have access to $20,000 year 1. Well, after 5 years, you might have access to $40,000, depending on how the market goes. So cash payment, we can basically get a big pile of cash for you at closing. 10-year payment, you'll get back a payment each month. So these are 3 ways that you can structure your reverse mortgage loan. So how is the qualified amount determined for the reverse mortgage? Well, it's going to be determined based on the age of the homeowner. So these are built somewhat like life insurance policies in the sense that they have actuary tables. That means that a person who is 62 can borrow less than a person who is 82, because they're basically counting on the person who's 82 being in the property less time. So they're giving them access to more cash. So that's the end of our presentation. I'm trying to keep these under 30 minutes here. I'm very passionate about helping people understand this program and about helping people move up in their lives financially. Feel free to give me a call if you have questions, just want to bounce things off me, or if you want me to take a look at your situation. We're very happy to be of service. Thank you so much for hanging out with me here for these 30 minutes, and I hope that you have a great rest of your day. Thanks a lot. Bye now.